The global economy is carrying an extraordinary burden. As of today, total global debt has surpassed $317 trillion US. This number includes government debt, corporate debt, household debt, and financial sector obligations. It is the largest amount of debt ever recorded in human history, and yet this number raises a deceptively simple but deeply unsettling question. If everyone is in debt, then who is the lender? At first glance, the idea seems paradoxical. We hear constant headlines about nations drowning in debt, corporations leveraged to the brink, households struggling with mortgages, student loans, and credit cards. The narrative suggests that everyone owes money. But basic accounting tells us something important. Every debt must have a corresponding asset. Debt does not exist in isolation. For every borrower, there must be a lender. For every liability, there must be an asset held somewhere else in the system.
Nice.
This means that global debt is not simply a collective burden, it is also someone else's wealth. So who holds it? To understand this, we must first understand how modern debt-based financial systems actually work. In today's global economy, money is largely created through credit creation. When a bank issues a loan, it does not hand over pre-existing money. Instead, it creates new money digitally by expanding its balance sheet. The borrower receives a deposit, and the bank records a loan asset on its books. This process repeats across the entire financial system. Banks, governments, corporations, and individuals all borrowing and lending simultaneously. Over time, this system grows larger, more complex, and more interconnected. Debt accumulates not because of mismanagement alone, but because debt is the fuel that powers modern economic growth. Governments borrow to fund spending beyond tax revenues. Corporations borrow to expand operations, invest, and increase profits. Households borrow to purchase homes, education, and consumer goods. The result is a global economy that is structurally dependent on ever-increasing debt. But again, the core question remains, who is holding the other side of this debt? The answer is not no one, and it is not everyone equally. In reality, global debt is concentrated in the hands of a relatively small number of actors who hold the corresponding financial assets. These assets take the form of government bonds, corporate bonds, mortgage-backed securities, loans, and other financial instruments. The system is not symmetrical. Most people experience debt as a burden: monthly payments, interest obligations, and financial stress. But for asset holders, debt is not a problem. It is a source of income, power, and control. Interest flows upward from borrowers to lenders. To see this clearly, we must abandon the idea that debt is merely a moral or behavioral issue. It is not simply the result of irresponsibility. Instead, debt is a structural feature of the modern financial system. And structurally, the system is designed to reward those who own financial assets. Another key concept the video highlights is the difference between money creation and interest creation. When a loan is issued, the principal is created, but the interest is not. This means that, collectively, borrowers must compete for a limited supply of money to repay not only what they borrowed, but also the additional interest. This dynamic encourages continuous borrowing, refinancing, and expansion of total debt. The system requires growth, not just economic growth, but debt growth. And as debt grows, so does the concentration of financial assets. This is where inequality enters the picture. Over time, those who own large pools of capital accumulate more assets, while those who rely on borrowing become increasingly dependent on debt. The system amplifies wealth disparities not by accident, but by design. Debt, in this sense, becomes more than a financial tool. It becomes a mechanism of wealth redistribution from the many to the few. So when we ask who is the lender, if everyone owes money, you're really asking who benefits from the structure of global debt. To answer that, we must identify the major holders of financial assets in the global economy. That is what we will examine next. To understand who the lenders truly are, we need to look at the balance sheets of the global financial system. While debt is widespread, asset ownership is highly concentrated. The world's debt is held primarily by four major groups, each playing a distinct role in sustaining and benefiting from the system. Central banks such as the Federal Reserve, the European Central Bank, the Bank of Japan, and others collectively hold tens of trillions of dollars in financial assets. These assets are primarily government bonds, but also include mortgage-backed securities and, in some cases, corporate bonds. Central banks expand their balance sheets through policies like quantitative easing, purchasing debt instruments in exchange for newly created money. While these institutions are often described as public entities, their actions directly support financial markets and asset prices. Central banks are not neutral actors. By absorbing large quantities of debt, they stabilize the system and protect asset holders from collapse. The second group is institutional investors. This includes pension funds, insurance companies, mutual funds, hedge funds, and sovereign wealth funds. Together, they represent the largest holders of global financial assets. These institutions manage retirement savings, insurance premiums, and national reserves. They invest heavily in government and corporate debt because it provides predictable returns through interest payments. In effect, institutional investors are the backbone of the global lending system. They channel savings into debt markets and collect a steady flow of income in return. The third group is foreign governments. Many countries hold the debt of other nations as part of their foreign exchange reserves. For example, large exporters often accumulate US Treasury bonds as a way to manage currency stability and store value. This creates a web of interdependence. Governments are simultaneously borrowers and lenders, tying national economies together through debt relationships. The fourth group is high net worth individuals and the ultra-wealthy. This group owns a disproportionate share of global financial assets. Through direct investments, private funds, and ownership stakes, wealthy individuals earn income from debt without experiencing its burden. For them, debt is not a constraint, it is a tool. These four groups collectively hold the assets that correspond to global debt. And while they may differ in form and function, they share one critical feature. They benefit from interest flows. Interest is the key mechanism here. Every year, trillions of dollars flow from borrowers to lenders in the form of interest payments. Governments collect taxes to service debt. Corporations generate profits to pay bondholders. Households sacrifice future income to meet loan obligations. This is not an anomaly. It is the intended outcome of a debt-based system. The video emphasizes that this structure creates a fundamental imbalance. Those who already possess capital gain more capital, while those without assets rely increasingly on borrowing. Over time, this leads to greater concentration of wealth and power. Importantly, this does not require conspiracy or coordination. It emerges naturally from the mechanics of finance. Debt compounds, assets appreciate, interest accumulates. The system rewards ownership. This is why periods of high debt growth are often accompanied by rising asset prices and increasing inequality. Financial assets inflate faster than wages. Those who own them prosper, while those who depend on income struggle to keep up. So when people say the world is drowning in debt, the more accurate statement is, the world is divided between those who owe and those who are owed. Understanding this division is essential to understanding modern economics. A central message of the video is that modern economies do not merely accumulate debt by chance. They are structurally designed to depend on it. Debt is not a temporary condition. It is the operating mechanism of the system itself. To understand why global debt must continue to grow, we must examine the relationship between money creation, credit, and interest. In contemporary financial systems, money is primarily created through lending. When commercial banks issue loans, they create new money by recording a deposit for the borrower and a loan asset on their balance sheet. This process increases the money supply and enables economic activity. However, there is a fundamental imbalance embedded in this mechanism. When a loan is created, the principal is created, but the interest is not. This means that, in aggregate, borrowers are required to repay more money than was originally created. To meet these obligations, additional money must enter the system. The only way this happens is through new borrowing. As a result, debt expansion is not optional. It is necessary. The system requires a constant flow of new loans to service existing ones. Economic growth becomes essential not only to improve living standards, but to prevent widespread default. If income growth slows while debt obligations remain fixed, stress builds rapidly. Businesses struggle to service loans. households cut spending. Governments face rising deficits. Financial institutions become exposed to losses. This dynamic explains why debt-based systems are highly sensitive to slowdowns. When borrowing accelerates, the system appears stable. Asset prices rise. Credit flows freely. Confidence is maintained. But when borrowing slows or reverses, instability emerges almost immediately. The video highlights that this dependency is the reason policymakers react so aggressively during economic crises. During downturns, central banks lower interest rates, inject liquidity, and expand their balance sheets. Governments increase spending and issue more debt. These actions are often described as extraordinary, but from the perspective of the system, they are necessary to prevent collapse. Without intervention, defaults would cascade through the financial system, destroying asset values and undermining confidence. Debt, therefore, plays a dual role. It fuels economic growth by enabling spending and investment. At the same time, it creates fragility by binding the system to continuous expansion. Over time, this creates a structural tension. Debt grows exponentially through compound interest, while real economic growth is constrained by productivity, demographics, and physical limits. As the gap between debt and income widens, the system becomes increasingly reliant on intervention. The video does not suggest that this process is driven by poor decision-making or short-term thinking alone. Instead, it argues that the system is behaving exactly as designed. Growth is required to sustain debt. Debt is required to sustain growth. This feedback loop explains why global debt has continued to rise, even after repeated financial crises. Each crisis results in temporary restructuring, but the underlying mechanics remain unchanged. Importantly, the costs of this structure are not evenly distributed. When debt expansion supports asset prices, those who own financial assets benefit. When crises occur, losses are often absorbed by the broader economy through unemployment, austerity, or inflation. The system survives, but the burden shifts. Understanding this dynamic reframes the discussion around global debt. The issue is not simply whether debt levels are too high. The issue is that the system requires debt to grow faster than income indefinitely, something that may not be sustainable in the long run. This leads directly to the deeper question addressed in the final part of the video. What does this system mean for power, ownership, and inequality? In its final section, the video moves beyond mechanics to examine the broader implications of global debt. Debt is not just a financial obligation. It is a claim on future income. And those who hold these claims hold power. When we ask if everyone owes money, who is the lender? We are ultimately asking who controls the flow of value in the global economy. The answer lies in asset ownership. Debt creates a clear division between those who owe and those who are owed. Borrowers must generate income to meet fixed obligations. Lenders receive interest and principal regardless of economic conditions. This relationship is inherently asymmetric. Borrowers bear risk. Lenders receive returns. Interest flows upward through the system. Over time, this dynamic leads to concentration. Those who own financial assets accumulate more wealth through compound returns. Those without assets rely on debt to access housing, education, and economic opportunity. This reliance reinforces dependency and limits mobility. The video emphasizes that this outcome does not require malicious intent. It emerges naturally from a system where money is created through lending and wealth grows through asset ownership. As debt expands, so does the influence of asset holders. Governments with high debt levels face constraints on policy. Corporations dependent on credit markets must prioritize financial stability. Households burdened by loans have less flexibility and security. Debt shapes behavior at every level. In this sense, debt functions not only as an economic tool, but as a mechanism of control. It allows influence without direct ownership and discipline without explicit coercion. The video also highlights how this structure contributes to inequality. Economic growth increasingly flows into financial assets rather than wages. Asset prices rise faster than incomes. Those who already own assets benefit disproportionately, while those who depend on labor incomes struggle to keep up. This explains why global wealth can increase while financial stress remains widespread. The system is not failing, it is operating according to its design. Understanding this helps dissolve the original paradox. The world is not a place where everyone owes money and no one is rich. Instead, it is a system where debt is widespread, but asset ownership is concentrated. Global debt exists because global assets exist. Those assets are held by a relatively small segment of the population. The video concludes by reframing the conversation around debt, rather than viewing it as a moral issue or a temporary imbalance. It presents debt as a structural feature that reveals how power is distributed. Debt shows who must pay. Assets show who gets paid. Once this relationship is understood, the system becomes clearer. The lenders are not invisible. They are embedded in financial institutions, investment vehicles, and balance sheets across the world.